We are back. Monday, the 30th of September, the last day for this particular month at the beginning of the week. We're very excited looking at what happened last week on the NSE and more importantly, what economic decisions came through the markets last week. We will be talking about the CBR decision that was left unchanged by the MPC, that's the Central Bank of Kenya Monetary Policy Committee. And so to actually explore what does this mean for us, is it the best way to actually make economic decisions with regards to the fiscal policy in this particular country, we are joined by Mr. George Bodo. He is a director at Callstreet Research and Analytics. Welcome to the show, Mr. Bodo.
Thank you, Mbide.
All right, so last week, a couple of decisions came out. Key in focus for us today is the Central Bank of Kenya decision by the Monetary Policy Committee, leaving the central bank rate unchanged at 9%. What were your thoughts on that? And what's your thinking around this particular rate used as a benchmark one?
Okay, so I think that well, it was a largely expected decision on the fact that, on the principal reason, on the fact that the monetary policy today and the larger monetary policy making today is being held hostage by the fiscal stance. So we're in a situation where the government, the fiscal policy is quite aggressive, and you can see that the government is actively borrowing.
Yes, it is.
To finance fiscal deficits, very aggressively borrowing, for instance, for that matter, actually. And so for that instance, in that case, the central bank is the Monetary Policy Committee of the Central Bank of Kenya is actually very cognizant of the fact that they need to keep the government's borrowing costs at manageable levels. So like, for instance, if they decided to be hawkish and raise the benchmark rates, which is a signal rate.
And by hawkish
means that they want to keep inflation low by raising rates.
All right.
And if they raise the rate, then that will have an impact on the government's borrowing cost, because essentially you'll see an upward review on the treasury bonds and treasury bill rates, and that's not good for the domestic
That's not
borrowing.
good for it.
Yes.
Okay, interesting.
So they have to keep in check.
So they have to keep it in check.
Yes.
So George, you did publish a report just talking about the CBR rate and the efficacy of the same benchmark rate. Please take us through what your thoughts are. So
I think my thought is that when you look at, and what is monetary policy today? Monetary policy is all actions that central banks do to keep the amount of money circulation at a certain level, the money supply at a certain level. So if they think that money supply is a bit high, which tends to be inflationary, if there's too much money circulation, they think that is too inflationary. They do actions that keep monetary supply down. So for instance, they raise rates.
Okay, so
they
that
raise
you can
rates.
actually,
So when they raise rates, the central bank, commercial banks will actually take cue and also raise the rates. And that in turn makes borrowing very expensive.
And you prefer to save in that.
And borrowers will be very hesitant to borrow because the rates are very high.
All right.
So in that way, they keep money supply low. If they think the money supply is actually very low, which is it's very deflationary. If not
so deflationary on the opposite side.
Yes, on the opposite side. Then they lower the rates, and in turn banks take key on lower rates, and then people go to the bank and take bank loans, and then money supply. So it's just they keep cycling it.
But this is the benchmark rate that now gives you a sense of what do you expect in the short to the medium term.
Yes.
Okay.
So it's if you look at the central bank rate, it's a signal. So they could hike it by 200 basis points, they could hike it by 50 basis points. But the idea is not in the quantum, it's just in the signal.
Yes.
What they're saying is that there's too money.
So
there's
it's
too
more of a
much
signaling effect.
Yes.
Okay.
Too much money supply, or there's the little money supply in the economy. We need to raise it up or bring it down. It's a signaling effect. However, what we've seen over the last 2 years is since the promulgation of the Banking Amendment Act, which is essentially the rate caps, that signaling effect has actually been impaired. As a consequence of the fact that banks cannot price above a certain level.
Oh, is it? Please elaborate.
So if you look at, for instance, now the Banking Amendment Act of 2016 has stated that you shall not price loans above 400 basis points. 400 basis points above the CBR, which is at 9%.
So that's 9 plus 4%. So that's 13%.
So that's 13%.
Okay, sorry, 13%. 9
yes,
plus 4%, 13%.
Yes.
Okay.
So essentially what that means that the signaling effect I've just explained may not be effective, in terms of bringing down or taking up money supply in the economy using interest rate as a signal.
So it's ineffective in your view?
Essentially, its effectiveness has been impaired with the rate caps.
Okay.
And so that means that what is the usage of CBR as a signaling tool now? It's as long as we have rate cap, and you followed the proceedings last week, Parliament has actually, the committee has refused to remove rate caps.
Okay.
So we are going to have rate cap for another, who knows, 12 months until the next budget cycle. Some minister, the treasury, a new treasury secretary, cabinet secretary can come up and do a new proposal. But
And
for the next 12 months,
at least we are remaining where we are.
So what does that mean for the CBR, the central bank benchmark rate as a policy?
What does it mean actually now for the CBR as a policy tool?
As a signal, it's ineffective now in my assessment.
It's ineffective. So then what happens? Are you saying that the central bank's objective, or rather mandate in this economy, being the institution that is responsible for monetary policy,
yes.
is it, then do we render it useless?
It's essentially useless in my assessment. Yes, it's useless in my assessment. In terms of that signaling function.
Okay.
It's useless because now, I mean, banks going to be pricing loans at 13%, all loans.
Yes.
That means that what happens if you are signaling that there's too much money supply, then you need to bring them down. What happens? The banks will not respond.
Okay.
They will not.
They're unable to respond.
They will not
to
take
that.
you there. They're not able to respond to that. So essentially, that means that that tool, as a monetary policy tool, the CBR is ineffective.
Okay.
The second issue is also the art of policy signalization, which is essentially there are a series of actions that central banks need to do to signal in advance. Like for instance, I'll give an example.
Yes.
If you go to the United States, which is, well, at the peak of monetary policy signaling,
okay,
the central bank's activities, the central banker's activities with public engagements or speeches are supposed to be monetary policy
So this
tools.
is anything that the Fed does or says
Even
actually
the
has
Fed
an
chairman,
immediate
yes,
impact
yes.
on the market.
The Fed chairman, whenever he's giving a speech, whether he's speaking a speech in a symposium or he's talking
People do pay attention to this.
They pay attention to this because every public engagement is a monetary policy tool.
Okay, but that's interesting because now when you bring in the element of the United States of America and any implications of what is said or communicated or implied by the Federal Reserve has an impact on markets. Is that the sense that we get here? Because why I ask that is in the last couple of months, we've seen a bit of political interference with what the Fed is actually doing. And that has had an impact on the market.
Are you talking about Trump tweets?
Trump tweets, political interference. So
yes.
is there an element of that in other banks, and would that be something that we would look out for in Kenya, or is it happening in Kenya or not?
Well, in Kenya, political policy signalization is very poor. I will take an example of the last maybe 20 monetary policy post-meeting communiques.
Yes.
I mean, you can actually, ahead of an MPC meeting, you can actually look at the way that the wording of that communique will look like. That is not signalization. So they need to give us more meat, what they're thinking,
yes,
right? The short-term view of inflation, their long-term view of inflation. And a consequence, we can be able to tell where, like for instance, we really don't know how they vote, for instance. The Monetary Policy Committee has about, I think, 9 members. And we don't know how they vote. By the way, policy decision has taken via vote.
Yes.
We don't know how they vote today. We don't know who said yes. We don't know who said I think I'm for raising the rates. I'm for holding it. I'm for cutting it. We don't know how they vote.
So we don't know how they vote. But then if I bring it back to this, because on one way you're saying you don't know how they vote and what they're voting on is ineffective in the market. So the question would be then, what tools do they have in their own mandate that they can be able to use to actually enhance policy signalization in this economy? So
one of the most effective way of interest rates as a tool is communication. So they say, if you read that, I mean, Ben Bernanke said in his autobiography that monetary policy is 98% communication and 2% actions.
Okay.
Yes. So we need to see more and more communication. For that, for interest rate signal as a tool to be very effective, which they're not doing today, it's very disappointing what they're doing today. For instance,
what would make you happy? What would
they need to, first of all, they need to release minutes of meetings.
Okay.
Yeah. We need to see what they said, what each member said, and how each member voted. Okay. That is very, very important, because then we get to their thoughts and how they're thinking about the economy.
All right. So minutes, and then if the minutes come out, what impact would it have? Would it have an impact on fixed income markets, equity markets, or all investment markets?
It will have an impact on all asset prices.
Okay.
As you know that interest rates and, for instance, equities are in inverse.
Yes.
Right. So if we are in an environment where interest rates are very high, then equity prices tend to go down, and for very simple reasons that people tend to flock to fixed income instruments.
Yes.
Yeah.
Okay.
Because then you expect that the price of fixed income instruments will go down, interests will go up, and that's very good for.
So you'd want the minutes to get a sense of what are the people sitting at this MPC meeting thinking 6 months forward, even though they leave the rates unchanged.
Yes, because they make decisions for forward. They make forward decisions.
That's true.
Typically,
okay. Then what's the other thing that you would like to see coming out of this decision meeting?
I think monetary policy today, the mandate of monetary policy today is only one. It's a single mandate, which is to keep price stability. Yes. And that goes into inflation. So their mandate, as far as price stability is concerned, is to keep inflation at manageable levels. And that's why they do have in targets. They say upper and lower targets. So right now the upper target is 7.5%. And
then the lower target?
I think it's about 5%.
Okay.
So if it got below or above the target, then it has an implication of what action they take. But I think also monetary policy, the mandate of monetary policy in Kenya today should actually be also expanded to include economic growth. Okay. Yeah, then that you'll see central bank becoming more proactive.
But they do give they do signal to the market what their expectations are with regards to economic growth. They always have an estimate every single year. Doesn't that actually mean that in a way they're they are involved in the process of evaluating whether GDP, the gross domestic product, is growing or not?
But they don't participate in achieving that growth. Like for instance, I remember last year, 2018, they had projected something above 6%. But how do you achieve 6%? You need to be proactive. Like for instance, if today central bank wakes up and say we are projecting 7% GDP, real GDP growth in 2020, they need to be part of that growth to the extent that you can't be projecting 7% and you're watching and seeing private sector credit growth at below 10% every year. Okay. Yes, they need to be very proactive because this is a credit-dependent economy. So
we actually need to see more coming out of the central bank in your perspective. But let's take a quick break. The NSE has just closed. Look out for the closing bell and we'll see you in a few seconds.